Welcome to the Door Roller Money Podcast. I'm your host, Rob Berger. Today in episode 309, we're going to talk about what's called the progress principle. Now that a new year is upon us, I thought this would be a good time for this topic. The progress principle can help motivate us really in any area of our lives, but in this case, of course, our finances. So we're going to talk about the progress principle, what it is, and then I'm going to give you 7 sort of concrete ways to apply it to your finances. So that's the plan. The progress principle, as the name suggests, is nothing more than the idea that if you're trying to reach a goal, the fact that you're making progress that you can see, that you can measure, helps motivate you. It helps encourage you. It keeps you moving forward, moving towards your goal. The phrase was coined by Teresa Amabile. She and her husband wrote a book called The Progress Principle. She's a Harvard professor. I believe she's at Harvard. If you Google her last name is Amabile, you'll find a TED Talk that she gave. Again, she's got the book, The Progress Principle. And, it's I think, very common sense. As we're trying to reach a goal, sometimes motivation is tough. And if we see that we're making progress, it can help us a lot. It can help motivate us to keep moving forward. I think of all things, losing weight. When I think of the progress principle, there have been various times in my life when I've been trying to lose weight. And, you may be going on a diet, and after a week of, let's be honest, hell, pain and suffering, you get on the scale and you've lost a couple of pounds. You may not be anywhere near your goal, but you're making progress. You're moving in the right direction. And those couple of pounds, at least for me, helped motivate me to keep going. So a very simple concept, but I think it's extremely important, particularly with money and particularly with long-term goals. If you think about saving for retirement, I think this is maybe one of the reasons that young people so often don't start saving right away when they get out of high school or college. You're 22, let's say, out of college. The last thing you're thinking about is life when you're 70. Number one, it's a long way away. And secondly, so you save whatever $250 into an IRA or 401k. That's a drop in the bucket to the whatever million or more or whatever your goal is that you think you may need at retirement. You haven't made any progress at all, or at least it doesn't feel like you have, and you've sacrificed. So it's this feeling that you've sacrificed, you haven't made any progress, what's the point, and you got plenty of time. All of those sort of come together as the perfect storm, I think, to keep a lot of people from saving and investing at a young age. And so the progress principle, by itself, it doesn't, it's not going to solve all of these issues for us, but I think it can help us. And so I'm going to give you 7 ideas for ways that you can implement the progress principle in your financial life. And I will say the very first one in my mind is by far the most important. And we've talked about all of these in different contexts, but the first one for me is the most important, and it's this: track your net worth. Your net worth is your scorecard, right? Your net worth is the result, the sum total of every financial decision you've ever made in your life, right? Because it's going to be the result of everything all the money that's come into your life, whether it be from working and earning an income, or investments and getting interest or dividends, or the value of investments going up, right? And everything you spent. I mean, you think about all of the daily decisions we make with our finances to buy this or not buy that, the way we earn money, the way we invest our money. That's all important. It's kind of like, the football game, all of the different plays going on in a football game, but at the end of the day, it's what's on the scoreboard that matters. And for us, our scoreboard is our net worth. And I find it very encouraging when I see our net worth going up, right? One thing I've found, particularly when you get older, is that and you've been investing for longer, your net worth, for us anyway, is influenced far more by investments and whether we've had a good year or whether we've had a bad year, than it is, savings. When you're younger and you're just starting out, your net worth is going to be far more influenced by your savings and paying down debt. But wherever, that's the great thing about net worth. It doesn't really matter where you are, whether you're just starting out, somewhere in the middle, somewhere closer to retirement, or even in retirement. Your net worth is the scorecard. And it can be a real shot in the arm when you see your net worth going up. Now, once you get into retirement, You may actually see it sort of flatline or even go down, but that's to be expected, right? But certainly when you're far from that goal, even relatively insignificant changes in your net worth, as long as it's moving in the right direction, can be a real motivator. And I've tracked our net worth for years in a spreadsheet. I'll be updating it this year. I actually expect our net worth will probably go down this year, although there are a variety of reasons for that. But hopefully most years it goes up. So that's number one. I think it's the most important. If you did nothing else, if you got nothing else from today's show, start tracking your net worth. You can certainly do it monthly, but I think annually is the most important. I kind of track it. I have a spreadsheet that gets updated automatically. You can track it in personal capital. There's different ways you can track it, but however you track it, even if you use something like personal capital, I do recommend that you also keep it in a spreadsheet because that's yours, right? It's not going anywhere. You have complete control over it, and I think it can be highly motivating to see that you're moving in the right direction. And if you're moving in the wrong direction for some reason or another, maybe it can help you make a sort of mid-course correction, depending on why you're moving in the wrong direction. Again, it could just be market performance, which we have no control over. But then again, it could be something else. So net worth, that's number one, the most important for today. Number two, something we've talked about as well, and that's the debt snowball. It's again, we talked about it actually briefly in the last show, but the whole concept of the debt snowball is that you keep making the same amount of payments, whatever you're putting towards your debt, until all your debt's paid off. So even if you pay off a loan and your minimum payments go down, doesn't matter. You keep paying the same amount, and you just apply that extra to different loans and the different debts. And what the debt snowball says is always apply any extra money to the debt with the smallest balance. And the reason for that is you'll pay it off faster, obviously, because it's got a smaller balance than you would another debt with, say, a much higher balance. And that act of paying off a debt is motivating. That's progress, right? That's the progress principle. It's a tangible way to see that you're making progress. Now, there's a bit of fiction there. I mean, as you make each payment month to month, your debt's going down by a certain amount, right? The fact that you get to a point where one debt goes away completely doesn't really change your trajectory. You're still reducing your overall debt by a certain amount each month. But it feels good. That's one less payment you have to make each month. That's one debt you can cross off your list. I mean, I remember with school loans, you can have a gajillion school loans unless you consolidate. And paying off a small one felt really good. Didn't matter what the interest rate was. It just felt good. And so the debt snowball is one way, particularly for those, obviously trying to get out of debt, that you can apply the progress principle. You'll see that debt with the smallest balance. You'll have a sense as to when it's going to get paid off. Hopefully it's soon. You work towards that goal. Bam, you've paid it off. Feels good. It motivates you to keep going. So that's number two. Now, number three is related. As we've talked about, the debt snowball, depending on what your interest rates are, I think for a lot of people, debt snowball, extra money goes to the smallest balance debt, versus debt avalanche, extra money goes to the debt with the highest interest rate. I think for a lot of people, it doesn't really matter. The difference between the interest you'll pay and how long it will take you to get out of debt might not matter a lot. Where it will matter is if your larger loans, your larger debts, have much higher interest rates, right? So for example, let's say you owed $20,000 on a school loan at 6% and $25,000 on a credit card at 30%. Well, under the debt snowball, you'd tackle the student loan debt first because it's smaller, $20,000 versus $25,000. But from a financial perspective, that doesn't really make sense. First of all, it's probably going to take you a long time to tackle the 20% or the $20,000 loan. So I'm not so sure how much progress you're going to feel you're making from month to month. But secondly, the $25,000 credit card debt has such a high interest rate, that's going to be killing you month to month. And you want to get that loan down and paid off as quickly as you can. So what do you do if you acknowledge the benefits of the debt snowball, but you don't want to pay the extra interest and you want to kind of tackle that high interest debt first? How can you still feel the progress? Well, I think a great way is what I call the debt thermometer. I don't know if that's a thing, but I've made it a thing. You know how, the school fundraiser and they're trying to raise money, so they draw the thermometer and they're coloring it in as they raise more and more money. So I don't know if you turn this thermometer upside down and you color in as you've paid off your debt, or I don't know. But the key is, don't think of your debts as individual, credit card here and a student loan there and a car payment over here. Lump them all together and have marks across there. It can feel good when let's say I'm making up numbers, you've got $21,000 in debt. When that total debt falls below $20,000, there's no magic in that number, but it's a big round number and it feels good when your debt falls below it. It's kind of like when your investments go above 10,000 for the first time, or 100,000, or $1 million, or whatever your number is. Maybe your number is 10 million or 100 million. I don't know. But whatever your number is, when you sort of go above that big round number, it feels good. There's nothing magic about it. It's all just in our heads, but it's motivating. Well, we can use the same thing in reverse for our debt. So rather than thinking about your loans as individual debts, and you want to get one paid off because that'll feel good and show progress, put them all together. I wouldn't include your mortgage in this, but I suppose you could if you wanted to, and start looking at it as a total, and have some goals in there. When you get below 10,000 or 7,500. Have a little celebration. Make it a moment. Probably wouldn't go out to eat and charge it on a credit card, but have some kind of celebration, something as you hit those various progress points, and you can set them wherever you want. Maybe it's every $1,000, and you hit that every few months, right? Or it's every $100, or it's every $5,000. I mean, again, you want to personalize this to what makes sense for you. But I think the debt thermometer, as I'm calling it, it could be a way to show your progress, apply the progress principle, but not necessarily attack the smallest debt first. All right. Number 4, savings rate. This is, I think, the right way to think about how much you should save, right? And you've heard, no doubt, different rules of thumb. Save 10%, save 15%, save 20%, whatever the number might be. The problem with savings, and I alluded to this earlier, is that putting aside $250, let's say, or $500, whatever your number is, for retirement, doesn't feel like you're making any progress. You've got this big goal that's 40 years away or 30 years away. It could be $1 million, some big number. What's $250? And so rather than thinking of it that way, set a savings rate goal. I think it should be at least 20% of your gross income. Now, I know a lot of you, that may seem crazy. That's okay. I'm just giving you my general opinion. If you save 20% of your gross income, you will be financially free. You'll have 25 times your annual expenses in roughly 25 years. All right. We'll talk more about that in a minute. But here's the key. You may not be able to save hardly anything right now. That's okay. Track your savings rate, right? So let's say you can save 3% of your gross income right now. That's fine. Now, work hard and celebrate when you get to 4%, or when you get to 5%. Or maybe you're at 5% and you're going to celebrate, you've set this goal when you get to 7.5%, right? And you're going to do that by saving half your raise and saving half your tax return, and maybe deciding between Amazon Prime, Hulu, Netflix, YouTube TV, I don't know. You're going to cut back in some way, right? Those are goals that you can meet in the relative short term, thinking maybe months. I probably wouldn't put it out more than a year. But track your savings rate. As you're able to increase it, keep track of that. Okay, I was at 4%, now I'm at 4.5%. Great. That's the kind of thing that you can measure, and because if you listen to the show, you know the power of compounding, that over the long term, the difference between, let's say 5 and 10% is huge. That's why the rules of thumb kind of crack me up, right? Historically, it was 10%. I think Dave Ramsey came in at 15%. Elizabeth Warren, before she was senator, wrote a book, and I think she was 20%. At one level, these might not seem like big differences. I mean, we know 10% versus 20% is a difference. But when you multiply it over a lifetime of savings, it's a huge, you're talking millions of dollars, depending on your income. And how long a period. If you're talking, say, a lifetime of working years, 45 years, let's say, the difference between 10 and 20% is like, it's huge. So, zero in on your savings rate. Figure out what your savings rate is now. I generally would say this. I would use gross, your before tax income, if most of your savings is in traditional retirement accounts. You can use after tax if most of your savings is in Roth. But the key is be consistent and keep track of your savings rate. Set incremental goals and then celebrate when you reach them. All right, number 5. This one is particularly important now as the stock market seems to be suffering some sort of cardiac arrest in the month of December. And we'll see how 2019 works out. But it's track your investment income. Particularly dividends, but also interest off of your bonds. If you're invested in mutual funds in a retirement account, you probably don't even give it any thought, because the mutual funds, they'll pay interest if it's a bond fund, they'll pay dividends if it's a stock fund, but it gets reinvested. You don't even know what happens, right? But I think it's important to track how much in investment income, interest and dividends, your investments are generating. And keep track of it I would do it on an annual basis. And there are 2 ways to do it. You can just go in. I mean, you'll see in your transactions in your account the interest payments and the dividend payments. They get reinvested, but you'll still see them with a lot of the stocks, say index funds. I know Vanguard distributes most of its dividends in December. I just got one a bit ago. But you'll also see quarterly. But December seems to be their big year. There are various reasons for that, or their big month for dividends. So you can go in and look at your transaction history and actually come up with the number and keep track of it. I would probably keep it with your net worth statement, right? So at the end of the year, you can say, all right, my investments generated X dollars in dividends and interest, whatever that might be, and keep track of it. The other way to do it is through Morningstar. You can register for a free account. You can track your portfolio, and it will show you the dividend yield of your investments. And based on how much you have, it'll give you a number at the bottom. Now, that can change as dividends change and whatnot. So at the end of the day, you still probably want to look at the actual transactions in your account. But I think it's a very good habit to track your investment income on an annual basis. Now, the question is why? Why am I suggesting that? As your portfolio grows, right, your dividend, your investment income, dividends and interest should grow as well, right? Here's the reason. Investment income tends to be far more stable than the actual value of the underlying assets, particularly in the case of stocks, right? Now that's not 100% true, but here's the point. So take Apple, for example. So it was trading at, I want to say it got up to 230 maybe when it was over $1 trillion market cap. And now, I mean, as I'm recording this podcast, I think it's down, they're practically giving it away. It's like $150 or something. Yeah, 158.82 as of recording this podcast. So it's come down a lot. Guess what hasn't changed? Not one bit. It's dividend. Its dividend hasn't changed. Why? Because the company is no different than it was when it was trading at 230. None. It's got the same cash. It's selling its products like hotcakes. They're just flying off the shelves. I was at an Apple store the other day at Tyson's Mall in Virginia. You could hardly get in there. And then I walked down to the Microsoft store and it was empty. Now, by the way, that's not to say Microsoft is not a great company. It's done phenomenally well. It's just a different company. In any event, Apple hasn't changed. Now, I understand why the stock has gone down. Part of it's just the market. Part of it is the whole concern over, iPhone sales maybe flattening a bit and its ability to market in, say, countries like India and China. I get it. But its dividend hasn't changed. And so tracking your investment income, I think, can give you a better picture of your progress than stock price. By the way, that's true not just when values are going down. It's also true when values are going up, right? So you may have a year when the market's up 20%, but your investment income's only up 8%, right? That might be normal. And that's okay. Because sometimes the market, goes up for reasons other than the underlying fundamentals. So I think tracking your investment income is a way to see your progress that's at least a little more closely aligned to the actual fundamentals of your underlying investments. I think it's a good habit. And it's something I'm just starting this year. I haven't done this in the past. This is new for me. So I'll be calculating all of my investment income, both retirement and non-retirement accounts. And I'll include savings in that. I'll look at my savings accounts and see what paltry sums they've generated this year. And I think it's a good habit. It shows you progress, again, in a way that I think is more tied to the fundamentals of your investments. It also, I think, can help you maybe to some extent stomach the down markets. Now, by the way, sometimes the markets go down and dividends go down with it, right? In 07 to 09, depending on the industry, I mean, the auto industry just crapped out on us, right? Dividends gone. Banking crapped out on us. Dividends gone. So in extreme markets, the dividends can go down too, but that's okay. I mean, it's something to understand and track. So, all right, number 6. Age of money. This comes from YNAB. I think it's a pretty neat statistic. Statistic's probably the wrong word. Data point. Obviously, this only applies if you use YNAB, which I do, and I'm loving it. But when you use it for a while, it takes a couple of weeks before this kicks in. You will see, and I'm looking at mine now, you will see this thing in the upper right-hand corner when you look at your budget called Age of Money. Mine's 25 days. That's how old my money is. Now, I will confess that I don't always understand exactly how it's calculated because 25 days doesn't make sense to me, in my case, for reasons I'll explain. But conceptually, I understand it, I think. And the idea is this. You get paid, you've got money, you're going to allocate it, you're going to budget it to groceries, to your utilities, to rent, mortgage, whatever. When do you actually spend it? So if you're living paycheck to paycheck and you get paid and you budget $200 for groceries, you're likely going to go out and spend it in a couple of days, right? And so your age of money is just a couple of days. On the other hand, maybe you've already got your money in the bank for the next 30 days. So when you get paid tomorrow, you're not spending that money right away. You're going to budget that for a month from now, right? Well, then your age of money is going to go up. And I think it's a good data point to track as you try to basically live, and this is YNAB's stated goal, I think it's a good one, live, you want to live on last month's money, right? So if you're in, make up a month, you're in June, the money you spend in June, you want to have earned in May, right? So the reason I say my 25 days doesn't make sense to me is that I'm always budgeted completely for a month in advance. Plus I have more to be budgeted. So I could actually budget 2 months in advance. So I'm not quite sure. Maybe the 25-day thing just hasn't caught up. But I think it's a good number to focus on. It's not a long-term thing. Eventually you're going to get into a point where you're at least 30 days with your age of money and you'll be good. But as you're trying to break out of living month to month, seeing that number go up will show you that you're making progress. And it may be slow at first. Maybe your age of money is 3 days or whatever, and then it jumps to 5. Okay, you see that you've made progress. Again, it's only if you use YNAB, but I like it, and I think it's a good way to show progress, and so I wanted to mention it. All right, the 7th and final one is something that I talked about in podcast 296, I think. Let me just double check here. I'm pretty sure it's 296. The 7 levels of financial freedom. Recall that I view financial freedom as a function of how many months or years worth of expenses you have in the bank. The ultimate financial freedom, what I call level 7, is having 25 years worth of expenses in the bank. And that's just based on the 4% rule. So if that doesn't all make sense to you, just go listen to DR 296, podcast number 296, and it will all become clear. The thing that I like about the 7 levels of financial freedom is that it takes a very long-term goal and it breaks it into chunks. And it allows you to see your progress over time. Recall that level 1 is just 1 month worth of expenses, which may not seem like much financial freedom, but trust me, and we've all been there, when you're living paycheck to paycheck, having a 1 month cushion is huge. And I've been there living paycheck to paycheck. It ain't no fun. And this is a way to break up this long-term goal into levels that are a little more manageable and can show you your progress. One of the things I found interesting, I Googled 7 levels of financial freedom dough roller, and what came up, one of the first things that came up was a calculator that someone else had created where you can put in your monthly income how much you're spending. And that, of course, the difference will be how much you're saving, and it will calculate how many years you need to reach each level or how many months. Now, I'd already created something like that using Google Docs. So if you Google financial, I'm going to do this just to make sure it comes up, financial freedom calculator. Yeah, dough rollers, the first listing in Google, and you'll see a link to a Google spreadsheet, and you can play with the numbers, and you can kind of get a sense as to how long it'll take you to get to level 7. The other calculator that I found shows you each level, so it's kind of interesting. But the point here, whatever calculator you use, the point is you can use the 7 levels of financial freedom as a way to track your progress towards that long range goal. So beyond the 7 specific examples I've given you, I guess the bigger takeaway is this. When you're working towards any long-term goal, it's important to be able to feel and see your progress. Sometimes that's not so easy. And so sometimes you have to be creative. And I've given you some examples here as it relates to your money. No doubt you can come up with others. But we shouldn't underestimate the value that tangible progress can have on our own motivations to continue on the path to whatever goal, whether it's health related, relationship related, in this case money. Money kind of lends itself to tracking, so I guess in some sense it makes it a little bit easier. And I hope you found that helpful, and I hope it helps you through 2019 as you've set your own goals and are working towards them. So there you go. Well, listen, I hope you have a great day, a great week, and until next time, as always, remember, the best thing money can buy is financial freedom.